Thank you, Brittany. Appreciate that. And thank you, everyone who has joined this webinar. As you know, some of you, if you're repeating attendees, you know that LoanNEX on a monthly, bi-monthly basis will host one of these webinars. We do this one to kind of inform the market of evolving trends in today's non-QM or non-agency market. That's what we focus on here at LoanNEX. And we also give an opportunity to introduce some of our partners, some of our clients that have been on the LoanNEX platform for a while. And today I have a very interesting panel and a very intelligent panel. I'd like to introduce Allison Ashmore, Vista Point CRO. Allison Ashmore is one of the key founding members of Vista Point with over a decade of sales experience. Allison is responsible for the company's overall sales strategy, including business intelligence, client retention and success, product alignment, pricing development, and marketing. Allison, I think you need to hire more people. You do too much for the company. Vista Point pioneered the non-QM closed-end second asset class in 2002, and now under Allison's management has over 1.7 billion in closed-end second production and 5 successful CES securitizations. Welcome, Allison.
Thank you so much for having me. Look forward to it.
Also joining me is Jim Fitzgerald, Bluepoint's SVP of Secondary Marketing. Jim brings over 15 years of capital markets leadership and experience with deep expertise in secondary marketing, strategy, and execution. Since 2019, Jim's been instrumental in guiding Bluepoint's pricing and market positioning across both non-agency and agency channels. We're excited to have him here today. Welcome, Jim.
All right. Thank you, Raj. Great to be here.
Great. Thanks for joining us. Jim has so many employees that he has somebody that actually turns on the camera and turns off the camera for him. So maybe you could hire someone from Bluepoint there, Allison.
Yeah.
Also on the call with me is Robert Trahan. He's LoanNEX's SVP of Sales and Support. Robert has an illustrious career in the non-QM space, with formerly being at Sprout and many other outfits in the non-QM space. Robert brings a wealth of knowledge, and we'll be kicking off today's deck when we get directly into market trends. Robert, welcome.
Thank you very much, Raj, and welcome, Allison and Jim. Looking forward to hearing your insights and sharing it with the rest of our listeners out in radio and webinar land.
So thanks. Robert, I'm going to hand it off to you since you're going to be covering these next 2 slides.
Definitely. Thank you, Raj. We've had a slight update in the MBA origination forecast going into the 2026 and 2027 years. They, due to the rates, the long-term rates staying where they're at right now, and they're not forecasting a large decline in those. Kind of the origination volume is looking to be fairly stagnant when it comes to agency and government production. Consequently, if you look on the next slide, or not the next slide, but the next panel, you're going to see where a lot of the potential, or we see the growth is going to be in the next coming years. And you've already seen that this is actual growth that's reflecting in the panel. You have a lot of the PLS market that is continuing to be very strong, typically around that 30% mark. But where you're having a shift is the actual shift from balance sheet portfolio products for these non-agency programs and moving it into the PLS market. And that's something that I'm going to actually have Allison talk a little bit about, because she's been living that for the last few years and probably been driving a lot of that increase. Allison, could you lean in on that?
Yeah, so you're exactly right. We've had, as we all know, a myriad of events since 2020 that have kind of led us to this place. So you rightly point out the reduction of balance sheet lending from the banks. So as we saw with the regional bank crisis, we have seen the non-QM market really become more of a safe haven, if you will, for jumbo type loans. So we certainly see that across our myriad of correspondent lenders. I'm sure Jim also sees that with his production, but we see a lot of near miss fallout and higher balance loans. So, and especially in the last 90 days, we've seen a massive uptick from what we're seeing across, our lenders across the nation of loan balances above $2 million. And again, a lot of that is full doc or bank statement, or maybe that near miss jumbo, maybe there's a 40-year AM, an interest only feature, or kind of the credit score might be below what a typical, or traditional portfolio type of jumbo lender. So we certainly see that being funneled into the quote unquote non-QM space. And those loans will end on a different type of balance sheet, usually an insurance company balance sheet. Sometimes they might show up in the PLS market, but usually with those types of borrowers, they command a lower interest rate. And so that's really sort of fodder for kind of that insurance company balance sheet. So what I think is safe to say is that those insurance companies have taken over what was traditionally the space of the regional bank for that kind of jumbo near miss or even sort of cleaner credit quality bank statement paper. In terms of the overall securitization market, to your question, yeah, that has grown. And we project, and also in looking at Asset-Backed Alert, they do some projections, and our house view is that we will see the largest PLS market in 2025. So just to give you a context, in 2024, across 44 issuers, we are at the end of that year, we were at 42.5 billion in securitizations. Now in 2025, and we're not even, well, past the halfway mark, but not close to year end yet. We're running at 36 billion. So it will, in certain order, surpass last year. And we certainly see that right from the LoanNEX at the origination level, and Jim at your origination level too. I'm sure you're seeing growing volume. A lot of our correspondent clients have had record months over the last handful of months because of this phenomenon. The other thing that I think is driving the non-QM uptick is just related to agency originators jumping into the space. So Robert, you pointed out these various types of interest rate choices by the Fed, and just overall with the economic space that we find ourselves in, we are in an elevated interest rate environment, and so agency production is depressed, and margins are very, very tight, and so a lot of originators, independent mortgage bankers, are really focusing on the non-QM and closed-end second as a viable product where they can get extra margin. Right, those loans are trading on the capital markets with significant premiums. So it has become a really important piece to IMB's balance sheet to offer the non-QM and closed-end second. And we certainly see that. It's an interesting stat that I saw, and I won't name them because this is a LoanNEX webinar, but a very large pricing engine who has a significant market share in the agency space saw a 400% year-over-year increase in non-QM scenarios. So yeah, that's pretty huge, and that really does speak to those agency loan officers, agency originators that are testing the waters of non-QM, either maybe dipping their toe in that kind of jumbo near miss, or really going full in into the full spectrum of non-QM.
Yeah, and Allison, not only that, I also think that there are a number of traditional agency lenders that had correspondent channels or origination channels. We're seeing those people add non-QM programs. Ultimately, they're probably selling to you and the likes of other institutional investors out there, but we're seeing them add programs on there, which immediately go out to their thousands of correspondent seller clients, right? So it's more and more entry into the space is definitely something that we're seeing. More people coming on board, more people adding non-QM programs to their portfolio programs. It's like the perfect storm. It's like 2018 almost.
Right.
And Jim, in terms of your volume in the non-agency space, what type of month-over-month growth are you seeing?
Yeah, definitely over 50%, this entire year of our, versus conventional government, well over 50% on the non-QM side. Definitely increasing as we go. Part of it for us is we also, we educate our brokers. A lot of them have been doing conventional govy forever, and we're very hands-on to help them transition over. It's kind of walk them through how the non-QM works, and offer them marketing information and such to get that going. But in general, we've been offering it for a long time. But yeah, increasing closing seconds, definitely. Allison, they're out there buying like crazy. That's a big thing in this market, of course. Borrowers don't want to give up that 2.5 first TD quite yet, so they're getting their cash outs, and cash outs up to 750, and we're seeing a lot of equity in that. We're seeing low, below 50% LTVs on those 500 to 750 balances. So I mean, it's beautiful paper.
Wow. Yeah, it is.
It is really good. And, you know, obviously, for a lot of the retail originators that are looking to get into the non-agency space, it's partnering with the right takeouts, using technology, little plug for LoanNEX, obviously, in terms of making it easy from a discovery and an execution perspective, and really from an eligibility decisioning type of query. It does make it easy for everyone.
Robert, there is
Go ahead.
Danny has posed a question in the Q&A that I think is definitely a hot topic that that we, if we want to address that now, or I don't know if I don't want to interrupt your flow
Let's look
there.
at it.
So Danny asks, at the last few non-QM events, the conversation seemed to drift to poor back-end bids on P&L only product, or bidders wanting to strip that product out of bulks. Any opinions on the P&L only product performance when securitizing? So yes, so in general, what we've seen on P&L as a doc type is it's picked up substantially this year and definitely in the last 6 months. So historically, P&L, and Jim, I'm sure you can attest to this. Historically, P&L was only, you know, maybe 15%, even 10%, a smaller amount, right? It was really the self-employed borrowers were going towards the bank statement 12 and 24 months. But I think because of, this is more art than science, so I don't have any data points, but my gut is, you know, more agency guys getting into the space, wanting to add automation, not wanting to train their, you know, have a sort of specialty underwriting team to go through 24 months of bank statements, even though there is technology to support that. The P&L is more efficient in terms of just a document type that you can, you know, request of your broker partner or your loan officer, your borrower, and then run through it pretty quickly, as opposed to the 12 or 24 month bank statements. So with that increase from that sort of operational efficiency level, we've seen that on the capital market side. Now, along with the P&L, though, what the concern is, and to your question, Danny, is really from a fraudulent perspective. So Fannie Mae came out with a letter probably 2 months ago about and saw significant P&L fraud in their self-employed full doc. And they sort of raised a flag on that to alert their originator partners to beware of P&Ls that are in a full documentation to support that self-employed borrower's income. And we do see that as well in the non-QM space. So that kind of reverberated through you know, balance sheet holders of the P&L asset class, as well as securitization holders. And so there's just, I would say, a little bit of a stink on the P&L doc type because of how easy it is to have fraudulent P&L. Also, we've seen, and especially in Southern California, that there's like a cottage industry of P&L creators. So you have folks that, you know, haven't necessarily gone through all of the accreditation to become a CPA, and are kind of becoming a broker's go-to to manufacture P&L, if you will. So in that case, it kind of is a gray line between, is it fraudulent or not? So that person that's creating the P&L did not do that borrower's tax returns, but they are fabricating a P&L based on what the borrower tells them to do. So it sort of goes into the gray area where it's more becoming a stated product than, I'm not going to call that fraudulent because it could be valid, but because that professional did not do that borrower's tax returns, they're just going off what the borrower is telling them. And so how robust is that documentation to support the ability to repay? So all of that is going into a conversation that's very recent phenomenon in non-QM, because historically P&L was a very small percentage of the market. But you know, the capital markets is very efficient. Right now, you're seeing a lot of, you know, multiple bidders on the broker dealer desks for someone to kind of buy what the risk appetite isn't for, you know, for one takeout versus another. So we're seeing some more creative ways to get liquidity for that product in the capital markets. And then in terms of in the performance, I would say we don't have enough data points compared to, you know, the almost 20 years of bank statement performance and securitization that's a very robust data point versus the P&L. We just don't have enough data points to say that it is materially performing worse or better than a bank statement.
Yeah,
And Danny brought up a follow-up in when you have P&L only, it's hard. We've all lived through the 2007, 2008 credit crisis, right? And a lot was driven through, let's call liar loans or fraudulent loans, etc. Well, when you are able to backstop it against actual real, a secondary validation, i.e. bank statements, and validating cash flow from like a 2-month or a 3-month bank statement, at least that adds a little credence to the actual P&L that's being provided. So that's a good counterpoint, Danny.
Yes.
And it's more to come in that arena, right? I mean, as things find their way in this space, you have new entrants coming in, not only on the IMB side, the originator side, but you also have fresh capital coming in the capital market side. You just mentioned that, Allison, in terms of the additional broker dealers jumping in, and there's a lot of money that wants to get in and chase the yield with the security of the backstop of the real estate. So,
Right.
more to come.
Yeah. On the P&L side, we're still following that. We kind of carve, we're doing the hybrid model. So we've kept those out of bulk, just cautionary. But we do, we don't do CTEC. We just don't feel it's as solid. And now we're tracking the CPAs. So if we're seeing multiple loans with under multiple CPAs, different borrowers, particularly the same broker, we're going to have a conversation. And the file has to make sense, of course. But we're really scrutinizing those. We take, we feel, we'll take the risk on them, to just make sure that they're clean product.
Yeah, we did see a little bit of an uptick in the middle of last year, and a continued kind of not uptick, but it's steady. And it was all being driven by P&L scenarios that were being run in the platform. So we don't break it out like other income doc types, but we could see it internally that, hey, there was an uptick in P&L transactions that were coming through the platform.
Mm-hmm.
Any originators getting into this space and are looking to do P&L, as an offering, just make sure that you are cognizant of the potential risks and you have the appropriate controls in your credit side to ensure that you can mitigate that.
Yep.
Moving on to our yield curve and credit spreads. This U curve continues to persist, and obviously when you look at it, some of the things that I saw out there, this happens 3% of the time, and usually is an indicator of some unrest afterwards. And it is you're going to see a typical reaction to these prolonged U curves is the short-term rates do drop through a correction with the policymakers. So that's what we're expecting to see. The longer term forecast looks stable, albeit we're not seeing a downward trend, a significant downward trend on those long-term rates. At least the market is showing us that. Allison, this is your world. Do you want to comment on this as well?
No, you hit it. The market is forcing the Fed, so there's a high chance of a 1/4 point cut in September at the meeting, but really the market's already priced that in. So I think it's unfortunately the dialectic between loan officers or the consumer and what's happening with the Fed and what Trump is saying. It's a misunderstood that, I'm going to wait, until September and then I'll do my refinance. But the market has already priced it in, and interest rates are not really going to change with that 1/4 point. It's just, maybe the cost of borrowing, certainly, or maybe renegotiate a warehouse line, some of those IMBs that are listening. but we kind of are where we are in terms of the interest rate, and just where non-QM is, it's right on top of agency right now. There is not a significant margin. And that's just because I think both Jim and Robert said this, there's so much capital in the market that wants to have access to private credit, which is resi credit, which is the non-QM close and second space. That's just pushing down that spread so that originators are taking that premium that they're able to get in capital markets and folding it back into the consumer. So we do not foresee, of course, there's always but there could be a black swan event, but we do not foresee that, through year end, there's going to be a significant bounce down in interest rates offered to the consumer.
Great.
Yep. And you mentioned about the tightening of spreads between agency and the non-agency world. We're definitely seeing that in the second graph on this slide. As you can see here, the agency is where we're tracking on the black line, and then the green and the gold line is where we're tracking the non-agency. The green line is DSCR, investment business purpose. And what has really been interesting is the sharp spread from the non-agency yield, and actually is tightening closer to be almost literally on top of agency. Would like to ask Jim first your thoughts and why we're seeing that spread from let's say the alternative income full doc non-agency execution compared to DSCR, and then Allison, I'd like to hear your thoughts as well.
Yeah, no, definitely. It's what we're seeing. It's interesting. The mentality for non-QM has gone from, not to say a dirty word, but subprime to this is superior to conventional and government in very many ways. A little bit more, self-employed borrowers, really tough on the conventional govy side. So there's not, it's kind of keeping those up. We're finding that, the conventional govy rates are coming down. And we have a lot of people, the people who get into them generally buy down the rate or do a 2-1 buy down. But we have a lot of power borrowers who are, obviously down in the 6s, 80% on the non-QM side. It's really becoming the preferred type of loan to originate, and with all the options and now that the pricing is pretty much the same, everybody's just diving in.
Allison, throw it over to you.
Yes. So yeah, the DSCR rate on top of the bank statement or full doc non-QM rate is an interesting phenomenon. I think there are a couple things going on there. So what we're seeing is, as we know, business purpose origination doesn't have the same licensing regulations as consumer purpose. So over the last year or so, there's been a pretty hefty uptick in DSCR originations from non-licensed originators. And what comes with that is usually, now it could be, well, I'll assume the positive side of the scenario. So with those types of originators, they most likely come from a commercial lending background. They're used to selling a 5, 4, 3, 2, 1 prepay or some sort of prepay structure, and their client book of business are experienced real estate investors that have portfolios. And so in that case, when you kind of have that more sophisticated mindset, you're going to have a conversation about, hey, you don't have to buy down the rate. I can put on, a 2-year 5% prepay, or a 5-year 5% prepay, or whatever sort of structure that borrower feels comfortable based on what they're trying to achieve with their real estate portfolio. And that prepay, because there's so much premium incentive on the capital markets for that effectively buys down the rate by putting that prepay protection on there. And so we are seeing, DSCR rates in the high 6s, low 9s with prepay protection. That's really, bank statements are kind of in that low 7%. So really on par there. So that tracks with your graph here. The bad side, of the negative side of that, is that we are seeing significant fraudulent activity. And this is also another thing that reverberated through the market over the last handful of months, where we had non-licensed business purpose originators doing a lot of fraudulent behavior on the East Coast in certain geos. And I think a lot of us got those memos from various aggregators, right? In Maryland, certain parts of New Jersey, New York. So there's a few different points of arbitrage from the consumer, broker, capital markets, et cetera, on the DSCR. So just like anything else, like we're talking with the P&L, just be cautious, make sure you have your risk and QC aligned within your organization. And then also just be prepared. You really shouldn't be having a high 6 or low 7% DSCR with no prepay, at least for Vista Point. And I don't think that there's too many buyers that would want to, pay up for that. So just, be cognizant that if you want to kind of play in that lower interest rate DSCR space, that you have a robust premium to ensure that you'll have some good liquidity on the back end.
But
Very good.
the appetite's definitely there for DSCR because the volumes, kind of speak to themselves. I'll kind of go over it in these trends a little bit, but I mean, we've been seeing very similar trends on investment properties, but in general, the volume of number of scenarios that are being run in our platform, around 40,000, unique scenarios at the end of July, which is kind of stable. What's interesting is while the number of scenarios that are being run in the platform has been, pretty stable, our lock volume is up considerably. So we're seeing more activity on the commitment side. And while the scenario activity kind of remains flat, about 90% of these scenarios that are being run in the platform are being met with programs that our investors and lenders offer on the program. But look at the attribute trend breakdown, and one especially for you, Allison. I noticed that the second lien activity has been upticking quarter over quarter to where it's the kind of the highest that it's been right now at 5% of the scenarios that are being run, and then 10% of the scenarios are HELOC and seconds, the HELOC portion of the second as well. But you'll notice that the investment property trends are exactly where you would imagine they'd be. They've just been strong. At the end of last year, we were looking at right around like 48, 49%, if I remember correctly, of the volume was DSCR. Now we're north of 55 on the volume of investment properties in DSCR. A bank statement also seems to have a little bit of an uptick in the last 2 quarters. I don't know if you guys are seeing those trends as well, but we've seen it through our platform. Jim, are you guys doing more bank statement volume than you were in the past?
We are, particularly in July, and a lot of that is cash out.
Yeah,
a lot of cash out across the board, but we had, we've been in around 40% cash out our non-QM. July spiked up to, we hit 55. So people are really starting to, ahead of the holidays and what have you, starting to look at their finances, I think, and we've been getting feedback that there was a pause, maybe in May, June, there's a little volatility in the rates a little bit before that, but borrowers are kind of holding out. We talk, we interact with the brokers a lot. Borrowers holding out. Now they're saying, hey, you know what? Just move. We got to move forward. We can always refi you later. And so people are looking at cash out, and I think it's gonna boom. And Allison, those seconds are just taking off like crazy.
I know it should be higher than 5%.
It will be.
Because we do because there's bank statement second liens, right? You don't have to do a bank statement first lien cash out. Put that borrower in a better position, and then come back in a year, and you've got a 2-for-1 deal with that borrower.
Yeah.
Smell it.
But yeah, we're glad that we like seeing that uptick in the close-in second. We released close-in seconds in our platform towards the fourth quarter of last year, so we make it really easy to find those programs as well. So hopefully, Allison, we could deliver more than 5% here in the near future. Just a little bit of a breakdown of trends by income doc type. This 13% that you see here, this other, Allison, this is what I was talking about. This is what we see is driving P&L right here. This is, of course, purchase loans, but 58% of the volume is there. DSCR, of course, still 43% of the volume. Full doc and bank statement, as you see, has been upticking a little bit. June 25%, 24% here. Even in the refi space, the Jim, as you mentioned earlier, there's a lot of cash out, but it's DSCR cash out, and to flip into new properties, I would suspect. But
I'll just do a plug that we also offer DSCR
Mhm.
seconds. So with an LLC as of LLC vesting. So if the
And
numbers
P&L.
work, yeah, just always run both scenarios for a borrower, whether the first lien cash out or the second lien cash out is the best benefit for them based on the blended rate.
yeah. So moving on to just a couple of things that Jim, you were talking about being successful. Robert talked about a little of this when he was discussing this earlier. But we find that our clients, the sellers on our platform that are most successful, are ones that partner with multiple takeouts. And I don't know how you guys feel about that. But we see clients that are most successful having multiple takeouts, partnering with the right people, getting educated by those. And I know you guys spend a lot of time, Jim. You said you spend a lot of time with your brokers trying to convert them over to educate them on non-QM. Allison, I know Vista Point spends a lot of time really educating the market about your closed-end second programs and the differences that you have there. But we also believe that creating a non-QM process that fits your business is a really important part of that. Leveraging technology, as Robert mentioned earlier, expanding your market reach, to bring these programs into your portfolio. And we're seeing more of that. I think last year when we were talking about like just brokers in general that were doing non-QM, about 10% of brokers last year, like middle of last year, were doing non-QM. And I would suspect, I don't know the exact numbers now. I'm sure somebody on our panel has that information, but I guarantee you it's north of 15% of brokers that are doing it now. We see a tremendous amount of activity on our platform, and we see a tremendous amount of interest, even in these webinars that we're holding here. So, Robert, if you have anything to add to that, Allison, Jim, please, would love to hear your thoughts.
Yeah, yeah, most definitely. Without you guys, we'd be twice as big. Mark and I would be twice as occupied. If you're selling and you don't have LoanNEX, you need to get it. What we do, a lot comes in the door. We're running BestX. All the sellers are coming up. If somebody's sticking out that day, we say, hey, do you want to throw this into the bulk queue, or do we want it? This is a great price. It's a low coupon. We don't want to get burnt on that. If the market shifts, we're seeing a great price from Vista. Boom, we're going to do a best effort on that one. That one's going best effort. But if you can't see that, you're fumbling around websites, rate sheets. You're trying to figure out, somebody's, pricing well one day and not the next. And if you're making assumptions there, you're losing out. So that's huge for us. The other thing we use it for is we get a call from a broker in AE. They have a scenario that's we're not publishing. We sit there on the phone and say, hey, we plug it into LoanNEX, get the eligibility. Yeah, these 5 guys are doing it. Great. We're on board with 3 of them. That's plenty. We can take that risk. Yeah, we'll do the loan. Here's your price. Off we go. So it's fantastic. It's absolutely necessary.
Yes, agreed. It's really important to have a solid distribution mechanism for pricing. So I think, Jim, you're sort of highlighting how it helps you on the back end from a capital markets kind of coin sorting across your takeouts. But it's also important for the loan officers, especially if they're new to the space, to have a technology like LoanNEX that can effectively provide all of the different non-agency, whether it's second, jumbo, first lien, non-QM, et cetera, at their fingertips. And not all pricing engines effectively support the non-agency space like LoanNEX does. So it's important for the organization. And yeah, we've had our pricing in LoanNEX for quite some time and are very happy with the relationship and also with our clients that leverage you all for that pricing mechanism. Yeah, the only thing I would say to add in terms of partnering with your lender investor or your investor is really important. Obviously, with the growth in volume and the couple things we've highlighted related to risk exposure, BestX is I get it. We're all in a tight margin and it's very competitive. but you want to be sure that you align yourself with a handful of partners that will take care of you. Mortgage is a long and complex cycle with lots of ups and downs. As Raj mentioned, we at this point partners with not a lot of correspondent sellers, but select correspondent sellers, because we do want to be sure that we have a very close relationship with them to be able to provide guidance ahead of the market. So we have incredible data that comes down from our capital partner, and we always bring that to our clients so that they're prepared. And like Jim said, if there's something that we see like top of house that's coming down the line, we're going to say, hey, maybe don't hang around at the bottom of the rate stack for the next couple of weeks, or make sure you get those locks, done ASAP. So it's always important, stay close to your investor and your warehouse lines as well, right? Those are all of your lifeline and everything you need to keep your business going. And non-QM is rocking and rolling for sure, but there are always cracks, and when things are rocking and rolling, there's always exposure for risk. So just be sure you stay close to your partners there. And I'm sure LoanNEX can provide a lot of insight on those topics as well, to be sure that you're taken care of and protected.
Especially for retail originators, who LOs, if all they're doing usually is agency and government, and that's 95 to 99% of their production, having them to learn something new and actually change midstream to figure out where to place a loan is not how they're wired. They are, especially the top producers, are really focused singularly on their specific markets, but they would like to add that additional revenue, but they don't want to do it if it's going to take them away from their bread and butter. So as the executives and the retail originators, for these retail originators, want to drive this higher margin with minimal risk, when you look at it, become an LTV exposure perspective. The credit scores are typically right on top, if not higher than agency credit scores, and definitely better than government. The asset class has proven to be a winner for people who really buy into the space. It's just getting those originators, the actual loan officers, the MLOs, to be understanding how to sell it. And that's where, technology, especially LoanNEX, that's what we focus on. That's what really helps make that. I think, Raj, you say it demystifies the non-QM space, right? And that's really what we look to do, and make it easy for the originators to get a quick answer, find something that's that they can place. They can find an eligible loan for their borrower, and then place it with their appropriate takeouts. So
yeah, absolutely. Yeah, I appreciate everybody's insight. I wanted to give, like we typically do, I want to give each of you, Jim and Allison, a little bit of time to speak about your companies. Allison, I'm going to start with you with Vista Point, if you want to take it from here.
Yes, thank you. So yeah, Vista Point is just over a 6-year-old company. We started as a conduit to acquire firstly non-QM loans. We have a securitization shelf. It's VSTA, the Vista shelf, that we have some first lien deals and more recently second lien deals. Our founder saw an incredible opportunity in the marketplace after 2020, with unprecedented home appreciation, as well as interest rates very, very low across agency borrowers. So we developed our non-QM closed-end second program that we released in 2022, and we've been gangbusters on that product. It's a really important initiative for us, and we see it as very important for consumer balance sheets as well as the IMBs that really dove into that product early and sort of carved a niche for themselves in that non-QM closed-end second space, are seeing that as a legitimate positive on their P&L. So currently our closed-end seconds, we offer all of our doc types similar to our first lien. So you can do a full doc, a bank statement, a DSCR, like I mentioned, P&L, VOE, et cetera. Yeah, I guess that's it. But we love working with partners. We love creating business plans with our partners so that they effectively can tap into the market and grow with us together. And we offer significant expertise across all of our account executives to help you build that business plan, or even just build out a specific guideline or proprietary program that you want for you. We've had great success working with clients to create, sort of specific programs as well that have a capital market sort of forward execution component, so you can take to market a differentiation in your product that will make you distinct. So we're really creative and flexible, and we love the non-agency space. We want to be sure that we're stewards, and like everyone on this call, to be sure that this product, has significantly strong performance and will continue to be an important asset class for multiple balance sheets.
Yeah, and you definitely don't want to get rid of Manny R on your team.
Yeah.
Seems
Yes.
to be,
Manny
just a little
Rodriguez has
shout out
been
to
with us
Manny.
for over 5 years now. He was one of our first sales team hires after me and our founder, Bill. So yes, he's an incredible asset to the company and a wealth of knowledge in terms of non-QM and structuring deals. So yes.
I feel like I've met Manny before, actually.
We probably, yes. Yeah.
Thank you, Allison. I really appreciate that. Jim, the floor is yours about Bluepoint.
All right. Well, we're 34. There it is, 34 years in business. Conventional govy, traditionally started with that, and jumped into the non-QM is pretty much when it came out, because on the wholesale side, options. It's all about options, and we're all about education, information. The more they know, the more, the better they come off to the borrower. You got to just be completely provide, absolutely perfect service if possible. You got a 4.8 Google review. We're kind of proud of that. But yeah, we do 6 different flavors of each of the SCR, the bank statement, P&L, and this kind of creates pricing and product niches for our brokers. So they're facing those. So they put it in LoanNEX and they say, hey, okay, it's this particular line and then if something changes, it might price better over here. So we want to offer that. We've been doing mini core for a long time. That goes well. We like to transition brokers to bankers. That's kind of our thing. We do have a delegated correspondent channel that we just opened for that, where we'd like to transition some of our mini cores into full delegated and bring on new business. Depending on the scenario, those will go as low as 1 million net worth on the delegated, depending on the strength of the company and how long they've been around. So we're developing that. Our marketing, we like to market for the brokers, white label marketing. The team here is just the best team I've ever worked with. Very cohesive. We all, just get it done. So we're here to, you got a deal, it could be super gnarly, and we'll figure it out. But yep, we're here on LoanNEX, ready to rock and roll. Just hit us up. They'll give you the information after the call.
Thanks, Jim. It is a lot about that. Having that right process. Yes, the relationship. We talked about this in the previous slides, right? Having the relationship, but having the tools also. And a lot of people don't realize that by choosing a tool like LoanNEX or an eligibility tool that really helps you find the products that you're looking for, non-QM products that you're looking for, it can be done. You could use it as a supplementary tool, right? It doesn't have to be your primary pricing engine. We'd love it to be your primary pricing engine if you do, majority of your volume in non-QM. Even if it's, even if it's some of your volume in non-QM, it's important to have engines like this to help you find the products that you're looking for. Those tools are really important for you to be successful in non-QM. So if you're an originator out there that's not doing non-QM and you're intimidated by it, you're like, oh my God, I have to read through all these matrices and guidelines, and it's, there's a lot here. Check out LoanNEX as a tool. And we think that, like Robert said, I use this term all the time. We do help demystify that non-QM. Robert, you may have something to add since you recently joined. Robert's been with us for 6 months now, and he's really come on to embrace the tool. He was at Sprout before, and they used it kind of really in a big way to get their products out to their clients before when Sprout was around. So, Robert, you may have something to add on that too.
Well, I mean, it really is the premier non-agency, non-QM pricing agent out there with the multi-level review of eligibility for your borrowers, end of the day. And one of the interesting things that we have recently rolled out is an enterprise retail lock platform that now is available for a lot of your retail originators out there. So if you have any interest, we would love to talk with you about that and show you how we can really improve your workflows and stand up next to your existing technology stack that handles your agency and your government products. So we like to bring our expertise to bear, especially in the non-agency space. So please reach out to everyone here. I want to thank both Allison and Jim for coming on board and sharing your insights. This has been we both enjoyed this conversation, and I'm going to pass it back to you, Raj, for closure.
Yeah, and some of you asked if we're going to that join late, if we're going to send out the recording to all the participants. Yes, you'll get the presentation and you'll get links to the recording sent out to you, so you'll get to see the full thing. Of course, if you want to contact Bluepoint, we'll have all the contact information in here. We even included Manny in this presentation.
Yeah.
He's not even on the call, and we included him. That's how great he is.
Call out to Manny.
Everyone email Manny.
Allison, thank you so much. It's always a pleasure having you. I've always said you're one of the smartest people I've ever met in the industry, and you truly are. So thank you so much for joining us. Your insight is always appreciated. Jim, one of the nicest guys I know in the industry, and just a great team to work with at Bluepoint. Very good people, very great partners of ours. So thank you very much, Jim, for joining us. Robert, as always, great to have you on the panel. Well, this is our first webinar without our CEO. This is a big deal.
Yeah, good job. Good job.
Big deal for us. So we miss having Eloise on. But thank you, everybody, for joining us, and have a great rest of your week and weekend. Thank you so much.